Your way, Gord.
Okay, hey everybody, Gord McCallum here from First Foundation Mortgages. This is the second of our weekly Canadian mortgage hangouts. I want to welcome anybody watching out there in internet land and or on the recording later on YouTube. Joined this morning by Gord Ross out of Calgary. Gord hasn't figured out how this whole interweb thing works, so it took him a while to log in. But welcome, Gord. How are you?
Doing well. Thank you very much.
Good to see you. Jackson Middleton from Regina, representing the Prairie Province, the breadbasket of North America.
Absolutely.
Home of the Riders.
Yep.
And Rob Campbell from somewhere near the center of the universe. How are things out there, Rob?
Good. Guelph, Ontario. Good. We're still in hot pursuit of Pierre Poutine, but I'll keep you guys posted.
Let them know when you track them down. Scott Dawson, we've got Scott in Vancouver, home of the housing bubble.
No, it's Toronto now.
Oh, okay. Oh, good. Well, that's good. At least we're spreading the love a little bit. That's nice. Are those Chinese buyers I see knocking on your window? Are they trying to pick up your place? Is that fair to say? We may go off a little outside.
I'll be quiet there for a second.
Folks, this is live.
This is not going to be a politically correct hangout, I assume.
Probably not.
We are representing the best of the best standards and ethics in the mortgage industry in Canada, but we're all human too, so we make mistakes. Guys, we had lots of fun last week doing this for the first time, and we got to talk about mortgage rule changes. Anybody have any other thoughts on the recent mortgage rule changes we want to catch people up on? Scott, you look like you have something to say. What do you think about the
we talked last week, and it was interesting. I was at a CMHC. They had their summer update seminar yesterday in Richmond, and I was actually surprised on the little amount of questions from other mortgage brokers to CMHC about these changes. Just a kind of what I kind of noticed there. I think everybody's just kind of accepting it, and working forward.
Okay, and do you get the same sense, gentlemen? Calgary, Gord, how are consumers adjusting this down in Calgary? Are there people stampeding through the streets thinking the sky is falling, or is this business as usual in Calgary?
No, I think it continues to be business as usual, and I don't think a lot of people understand the changes. They know something's going on. There's a lot of hype in the media, obviously, but I don't think people really appreciate what the differences could mean for them. Although I do think that the consumers now are coming forward in almost a frenzy to complete a mortgage transaction before July 9th, just, in the sense that they may not be able to get a mortgage ever again post the change, right?
So there's, on one hand, it sounds like some apathy or lack of understanding on one hand, and then on the other hand, maybe unreasonable fear.
I don't think it's apathy, Gord. I think it's misinformation. People they're talking to their friends and family, and no one really knows what's going on. They just know that it's going to be a lot harder to get a mortgage, or at least that's the perception.
Right. Jackson, do you think is there a particular group of people that these changes are going to affect the most? And maybe we should give a quick. Just hold your thoughts on that, Jackson, just as we give a quick rundown of, and guys, correct me if I'm missing anything here, the main mortgage changes that we're discussing today are, last week there was an announcement both by OSFI, which is the Office of the Superintendent of Financial Institutions, as well as the Finance Minister, two different changes. The new ones coming in effect on July 9th relate primarily to qualifications, so debt servicing ratios, and the amount people are able to refinance. They're only able to refinance to 80% now on an insured basis as opposed to 85%. And of course, the maximum amortization, that's the one that probably most everybody's talking about, going from 30 years on an insured mortgage down to 25. Have I covered the main changes for July 9th? Okay. So Jackson, back to the question. What do you think about the who are these changes going to impact the most out in Regina?
Well, I think, my market is primarily to deal with first-time home buyers, and I think this is going to hit them right where it is. But, I really agree with Gord Ross. I think there's a lot of misinformation out there. I was actually in a couple of first-time client meetings yesterday, and it's funny because both of them said, I said, okay, are you aware that the government's made some changes? And actually both of them said, yeah, I heard something. So do we have to come up with 10% down now? I find it very interesting that that's where people jump, and they don't really know the changes, and they feel like it's always the down payment amount that's been adjusted, and I don't know, maybe that's being talked about for the next set of changes if it doesn't, figure out this housing bubble that we're in. I don't know, but no, I think that this is going to affect the people trying to get into the market. As the house prices increase, I mean, it's tougher to get into a first-time house, and from what I can tell and what I've heard around, it seems like these changes are, it's comparable to about a 1% increase on the interest rate. So.
Okay. Hey, Rob, I'm curious to know in Guelph, we hear a lot about Toronto in the media, and I know some of us Westerners, we kind of get our noses out of joint because we feel like maybe the national policies are being set with a fairly broad brush, kind of as they relate to the largest market in Canada, which is Toronto. How are things going out in Guelph? What's the market like out there?
The market's red hot. The market's crazy. I kind of have a good relationship with a couple of realtors who are good with numbers, not just good at selling homes, but good with understanding numbers. And it's some would say that it's healthy growth. I don't think that it is. I don't see a lot of, people always talk about, well, there has to be job growth, there has to be sustainability for the market to increase like that. But my big question is always, are the wages increasing? Yeah, there's job growth. Oh, that's great. But if those are all $9 an hour jobs, that does nothing for buyers and their attempt to become homeowners. So the values are, sometimes the values are crazy. I've got clients right now who are lucky. They pounced on a sale that's reasonable, and it's a nice home, and it's just been redone. It's basically a flip. But then you look at, there's a house around the corner from me that was listed at $399. It was a one level with a kind of crawling loft up top. It had been gutted and redone, but still, at the end of the day, you're still getting a very small home with 2 bedrooms for $400K, and it's sold. It's sold just under listing. But it's sold, and that was surprising. So it depends on what pocket, obviously, of the neighborhoods of the cities you live in. But I think the prices are still aggressive. So maybe to kind of come back around to answer your question, the prices are constantly inclining. Year over year, they're inclining like crazy. But I just don't see the sustainability with no wage increase. Yeah, there's jobs being created, but you're not going to have 6 people living in a home that are all working for $9 an hour, right? That's
a good point. Obviously, the housing market seems to be driven by employment, and where it's strong, when people have jobs, they're more comfortable spending their money and setting down roots and things like that. Scott, Vancouver's been talked a lot about in the media, and tell us a little bit more about the current state of the market there and where you think it's heading over the next 6 to 12 months.
Sorry, I just missed that first part. It didn't come through on the sound. Could you repeat that?
Oh, just curious to know. Vancouver's been talked a lot about in the media over the last couple of years, and the values out there highest in the country. There's a lot of different factors that play there. Wondering if you could give us your thoughts on what's going on in the market and where it's going out in Vancouver.
Speaking from kind of experience. And kind of word on the street, I've had a couple of meetings with a couple other mortgage brokers from my office here in the last couple of days. Obviously, discussing internally about these changes, how they're going to affect our business and working forward. Vancouver 3-4 months ago, 6 months ago, obviously was the hotspot of the country. We had what was perceived in the media with a lot of Asian buyers coming in mostly to the kind of the west side of Vancouver. Purchasing freestanding homes. Now, if you've read through the numbers on that, you'll realize that the house prices there got so out of whack with bidding wars, etc., that it really skewed the whole number for houses across the whole lower mainland. Like that's how much that one area affected it. Now going forward, it's interesting how the attention of the media has really shifted to where Rob is into Toronto, and we're reading articles in the paper about a lot of these reactions to these new mortgage rules were from what's happening in Toronto. So in the next 12 months, I mean, I've noticed a shift here. It's definitely quieted down. I work with a fair number of first-time home buyers as well. These rules will affect them in the Lower Mainland here. To kind of confirm what you guys are saying as well, there's still lots of confusion out there. Every time the rules are announced, there's lots of confusion, and I think in the next year or so, it's going to take some time to kind of get the confidence of the buyer back up. Big consensus here with a lot of the first-time buyers is they're kind of waiting for prices to drop, and if you really look at certain areas here, they already have within the last few years, especially the condo market. It's been pretty flat. So I see that kind of continuing. I just hope that with these changes and with the discussion of the market dropping, it doesn't kind of become a self-fulfilling prophecy and it just bottoms out on everything.
Well, I guess timing the market can always be, whether it's real estate or investments or anything. There's always some risk that comes with that, I guess, because right now, I guess people who are not purchasing are also potentially missing their window on interest rates. Now, there doesn't seem to be any pressure for rates to go up now, but if they wait long enough for values to correct, they may end up paying more in the form of interest as opposed to principal. So it's one of those, I guess, at least people are paying attention and trying to pick a time that works for them.
Well, that's what sorry, I'll just go on to that. What I've noticed with buyers, that a lot of them that I work with, they're being very cautious, but they're also, Rob's talking about jobs and everything else. I mean, people are cautious with things. The economy's still shaky, and they're going into a property with a lot of thought now. They're not. It's actually, I think, a kind of a good thing. They can take their time. They can find the right property here, and they're buying things that they're going to be in for a number of years. We're seeing that. So that's.
Yeah. Okay. Hey, now I'm curious. Show of hands, guys. I want to see everybody. I want everybody's thoughts on this. With the new rule changes that were announced last week, both by our finance minister and by OSFI, that'll come into effect later in the fall. Who here, show of hands, thinks that the regulators are done tinkering now for the next little while? Say the next 3 years. Are we going to have 3 years of regulatory peace? I'm hot. Maybe it's just the optimist in me. I'm going to say I hope so. I don't know for sure, though. I'm not getting a lot of support for that. Okay, so tell me,
what additional changes would you think would be coming down the pipe?
What are the changes?
There's some very different things going on. The one that sort of strikes me as being interesting is reducing the amount of refi to 80% of the value of a home. What is the purpose and the intent there? And I think it's to protect Canadian consumers from using their homes as a bank account.
Okay.
Would you agree?
I think I would agree with that. I think they see that. I think that they see, if you look at the numbers at what's projected, especially in the major centers. I'm about an hour and a half out of Toronto to the west. So, and we have a university in our city, and we've got a lot of stable stuff happening. But in an inflated market, I think their concern is the numbers that are being tossed around at potentially a 10 to 15% contraction in prices. And I think that's really what they're trying to get, like, nip in the bud right now before it's too late, because people will be potentially close to being upside down if they were still refining 85 or 9. Like if you did an 80, like let's do 85% loan to value refi with a cashback, like you're at 88 or 89% if you went that way. You know what I mean? So I think they're trying to nip that in the bud before it actually gets to that contraction in prices. That's my thought.
And I think probably maybe one of the bigger problems is 29% interest credit cards and consumer cards and these sorts of things. People get overextended in that regard, and then they use their homes to bail themselves out at 3 or 4% interest.
Sure.
Bingo. And I think we all are, and everybody in our industry does a good job. Well, not everybody in our industry, but at least all of us up on this panel.
99.9%.
Yeah, do a great job at informing our clients or informing clients to be or past about how to maintain a good creditworthiness, how to keep your debt down. But at the end of the day, you know, us as professionals, but also us as consumers know that you can lead the horse to the well, but you can't make it drink. I mean, what people do when they get a line of credit paid out and it's not closed as part of a condition, it's some people view that as free money, and away we go again. So I think you're right. I think avoiding that cash machine all the time is really the general consensus across the market of what they're trying to do.
One of the comments that I saw that I thought was really interesting about some of these changes was that it doesn't really attack the problem necessarily of too much debt. And like Gord pointed out, it actually can make things worse in the short term for people because they're unable to consolidate higher interest debt and higher payment debt into a lower interest rate, lower payment kind of environment, which is sometimes the only way to get out of these kinds of messes people have gotten themselves into. But it's not really a conspiracy theory per se, but one of the things that was briefly touched on in one of the articles I read about it was that this is a way not of reducing the overall debt exposure Canadians have, but reducing the exposure that the Canadian taxpayer has to that debt, and in the form of the guarantee, right, that CMHC provides or the other insurance provider. So the debt problem isn't going to go away necessarily, and unfortunately for some people, they may have a harder time dealing with it now as a result. But it's a personal responsibility thing now for them. If they default, it's between them and their lender on their credit card or their car loan or whatever. And it's not, they don't drag the taxpayer in with them. Do you guys support that idea? Do you think that's sort of what they're trying to get at here?
Absolutely. I think that's bang on. And I think, you know, you talked about future changes. I think some of the focus has to be on the root of the problem, which is high interest credit cards and loans and vehicle loans and these sorts of things, rather than focusing so much on the mortgage vehicle itself.
Yeah, it's been interesting to see over the years as interest rates have gone down. Credit card interest rates haven't gone down at all, from what I could tell. I mean, it's typical standard credit card might be 18.5% or something like that, and it was 18.5% 5 years ago when mortgage rates were double what they are today. Very interesting to see.
And isn't that interesting? Isn't that interesting indeed? I mean, that just reflects really where all that money is kind of where the problem's coming from. The root of the problem. When things go down, when rates go down, it doesn't seem like consumer debt rates plummet with it all that quickly. And now you have people advertising. Not people, but businesses advertising in the media hardcore to try to get people in on a line of credit before those limitations maybe get hacked down to 65%. And guess what? They're held to whatever adjustments in the fine print. They're held to whatever adjustments that lender makes in regards to that line of credit at 80%.
I would suspect we're going to start to see a real growth in unsecured personal lines of credit again. We may see, you know, those issued the $10,000 or $15,000 personal lines of credit issued at Prime Plus 3 as a bit of an alternative. If, you know, from a consolidation perspective, it's not 18%, but it's certainly not 3 either. That may be the thing coming. And what's interesting too is if you notice, a lot of the lobbying that went on behind the scenes was done by the banks who issue those credit cards. So very, you know, kind of telling. It's like a save us from ourselves kind of an approach. We don't want to stop lending on mortgages because it's a competitive environment, but at the same time, we make money by lending. So, guys, any unintended consequences from any of this new legislation? I think we probably all agree that the intent is good. If it's to save or help Canadian consumers adjust their lifestyles and maybe be a little bit more modest in their borrowing and things like that. But what are the unintended consequences that could come out of this these changes?
See, right now, I'll jump in on that one. Right now, I I don't mind the changes. I look at them and I see that they're good. I mean, it'll affect the amount that the borrowers I deal with qualify for. It might make them actually sit back, save some money, take account of their finances, pay off some debts before they can get in. The real kicker is going to be, like what you said earlier, will there be any more changes? I mean, from my understanding on a big level, these changes are good for now, and they've relieved pressure from the Bank of Canada having to raise interest rates.
Yeah.
However, if the government goes and in 6 months they start a pretty steep incline on interest rates, coupled with these mortgage changes, that's going to be very, very tough. It'll be considerably tougher to get into a place. And so these changes alone, I don't know. I don't think there's going to be a lot of negative consequence, but if all of a sudden they increase the down payment to 10% or the interest rates start going up like crazy, I think we're going to be in a lot of trouble.
Anybody, okay, we're going to do a little thumbs up, thumbs down thing, and just give me a thumb up if you think over the next 6 months interest rates are going to go up, and a thumbs down if you think they're going to stay flat or go down in the next 6 months.
6 months, yeah, down. Like this.
Yeah.
Unanimous.
Unanimous.
Yeah.
Yeah, there doesn't seem to be any pressure in the immediate term. I guess the risks, a couple of drivers that can obviously drive interest rates, inflation, that doesn't seem to be coming anytime soon. In fact, oil prices are coming down. That's usually puts a little pressure on inflation, and consumer spending is coming down. People are not going to be buying as much because credit isn't going to be as readily available. So inflation doesn't seem to be a pressure. I guess one thing that we could see potentially creating a bit of a rise in our interest rates is if the American economy really recovers strongly, and they seem to.
That's a good one. Can I write that one down?
Yeah. I think there's really that's a long shot. That's betting on a bad horse.
Gord, haven't you heard that Canada is picking up the U.S. as a revenue property?
Whoa.
But that would be
Arizona.
the world's biggest blanket market.
Yeah, that's right. Across all 52 properties or 50
Inter alia. One per state.
I think the big elephant in the room that everybody's got their back turned to is Europe right now. I think Europe. You've got, was it Spain? The guy from Spain basically standing up 2 weeks ago saying, "Don't worry, we've got this. We're gonna, we'll take care." And then this week, gone. He's gone. He's out. He's gone. He's walked away. Look, this is a massive problem that nobody over there wants to address. And you've got, I don't know if you or any of the viewers that are going to be watching this video watch Nouriel Roubini. When I watch Nouriel Roubini speak, he's known as Dr. Doom. But you know what? He spits the truth. Everything that man has said in the past 2, 3, 4 years has come to reality. And
okay, well, wait a sec, time out, because I have an issue with that. Rob, I guarantee you tomorrow the sun's coming up. I was just right.
Oh, yeah.
I was right.
I know. Go ahead and Mr. Positive. I know underneath that red shirt you've got a big blue P on your chest.
No, but if you put the Nouriel Roubinis, the Garth Turners of the world, who's the other guy from Ben Rabideau? If you put all those guys in a room and let them...
Jeff Rubin, is that his name?
Rubin, yeah, $200 oil guy. Every time you put these guys in a room and turn them loose and let them prognosticate the future, eventually one of them is going to score. It's just they take enough shots at the future, and have you ever noticed none of them ever say it'll happen by this date? By this date, it's going to happen, guaranteed.
Roubini is actually giving some years. He's saying years. I know you're going to laugh at that, but
they eventually start to sound like that guy who was predicting the end of the world in last October, and then was wrong and said, you know what, I miscalculated. Well, it's coming again.
My calculator's battery was a little wonky. I had to put it in the freezer for a little while.
Yeah. So I don't know. If you say something long enough for long enough, you might get close enough to right that people will think they'll buy your book or something. But I have a healthy dose of skepticism about some of the prognosticators.
I hope you're right.
I hope I am too.
But then, to finish up, I'll quickly just finish up. I think it's a big thing that nobody's really paying attention to. Only the real hard number crunchers are paying attention to, and the numbers and the academia of that can understand that kind of massive amount of numbers and stuff that's going on over there. But even in America, you know, everybody's kicking the can. Europe's kicking the can. America's kicking the can. They've got elections coming up. They've all got elections going on. Nobody wants to make any drastic decisions. I think, and that hence driving the rates lower. That's why I said lower, because Canada is going to be a great safe haven for international money. I think we're going to have a great recovery, but when, I don't know. But yeah, that's my 3.5 cents.
Guys, doesn't it come down to fundamentals at the end of the day? Eventually, if your fundamentals suck, they catch up with you, right? If your government's borrowing too much, or your people are borrowing too much, and you're spending more than you've got, at some point it comes back to bite you. And probably the places in the world that are more moderate in those areas seem to be doing the best right now.
But Gord, how isolated do you think Canada is from the rest of the world?
Yeah,
assuming we've done it right, or we've done it better than some.
Sure.
Is that going to be a long-term solution, or is there stability for Canada?
Well, money, that's a great question. I think money, I learned this coming from Saskatchewan, and then watching a lot of my ex-Saskatchewanian Albertans go back. You know, money's mobile, and money and talent are both mobile, and I think people are going to go where the opportunities are. The money's going to go where the opportunities are. Rob touched on, you know, we're a safe haven for money right now, which is why our dollar is high and our rates are low. But what happens as soon as there's an opportunity somewhere else? When somebody else if the state starts to get their act together, is that money going to leave our marketplace and go looking to score down there? You know, it'll be interesting to see. Yeah, it's always mobile. You always have to be competing, I think.
I think Canada is going to be neck and neck with the leaders in the next couple of years. I think we just have to mind how we do business and our willingness to do business with other countries. But I think we're up there with most. I don't see a steady recovery in the States. I just don't. I don't think that any of the first world nations or even second world nations that are facing these kind of massive adjustments in money and monetary policy, they're not moving quickly. They're not moving with any sort of new world thinking. They're all pretty much focusing on the way it has been. And it's clear that the world's in a huge adjustment where what were third world countries are now quickly becoming first world nations. Brazil, China, India. So yeah, I don't think America's going to be seeing any quick recovery anytime soon. I don't want to call it like the Japan of the 2000s, how Japan was in recession for 10 to 20 years, basically. But I don't think it's going to be a quick recovery down there. So people are just not quick enough to make change.
There's an awful lot of debt. You know, anybody else have any thoughts on the States?